Hello, this is Colin and welcome to Grad School TV. This is Module 2 in the Corporate Finance subject. And this week we have a question about 3 loans offered by 3 banks. The loan is for $20,000 and we have banks X, Y and Z. And we have the principal value over here of $20,000. The question is which one is offering the best deal. Now, these blue cells here are the information that was not provided to us. So everything else that is not a blue cell, this was all information that we had. Now, I asked Akhtar, how do you do this? How do you solve for I for banks X and Y? Well, trial and error was the answer. That's okay if I've got lots of paper and I'm willing to do lots of calculations. And this is where the Excel spreadsheet comes in handy. And so I thought I'd make a little video and show you how I did it. First of all, it'd be easy to just say monthly payment times the number of months gives us the number of, or the amount of dollars that was paid back. Then you subtract the principal from the total amount paid and you would get the interest payment paid. But of course, if we're only comparing the amount of interest we were paying, and I guess I could put that in a column down here on the right, we're not actually fully comparing the rate, which means we're not fully considering the time value of money. So let's have a look at this last one here, Bank Z, because we know the rate and we know the months, but we just don't know the payment. So what I've done is I've created this column here, which gives me the monthly rate, and then this column here, which gives me the number of months. And then if I double click in here, you can see I've used the present value formula, and I have the rate, which is that figure there, which is this one here, which is basically that divided by 12. Then I have the number of periods, which is this cell here. And then I have the payment, which is that cell. So trial and error in this case actually led me not to $460.20 straight away, but let's try something. If I put 400 in there, you can see that $400 at that rate of interest is not going to get me to my present value. So that payment is not enough. So if I was to try 450, oh, okay, that's looking better. I'm getting closer. If I try $460.20 as a lucky guess, bam, straight onto 20,000. That looks pretty good. So in these cases here, I've done exactly the same thing, noticing, of course, that if I just move him out of the way slightly, in this case, the figure for the number of payments has changed to 48 because it's a 4-year loan term. What I can do is I can once again experiment with this interest figure. And if you have a look, 12.75% gets you to $19,997.32, which is close enough. And the Bank X, $455 per month over 60 months at 13%, will give you the same result. So here's all my $20,000 present values. But here, more importantly, are the interest rates. Now, the question says, which loan do you prefer, and explain why? Well, as I said in the text part of my post, this is a personal loan. Personal loans are usually unsecured, which means you're usually buying a car or a holiday or a boat or something like that, usually not a house. Or shares or stock, equity. And because it's unsecured, you're going to attract a high rate, and you would say that these are high rates. No one's going to buy a house at 13.5% unless you were, well, 20 years ago. And so the most important thing to consider here is if you're borrowing money for a depreciating asset, you want to be paying as little interest as possible for as little time as possible. So looking at it this way, Bank Y gives me the lowest rate, the shortest term. However, it does also give me the highest monthly repayments. And therein lies an issue. If cash flow is a problem for you, if you just don't have $534 a month, you may have to go for one of these. But let's assume that we all do have $534 a month for that nice new car that we bought. Bank Y becomes the bank of choice. Thanks for watching Grad School TV.